I'd also now like to invite Anne-Marie Slot, who is going to chair the next session, and she will introduce the speakers. She's the Global Sustainability and ESG Partner at Ashurst, who's been a great supporter of our work over the last few years. Thank you for today.
My pleasure. Just grab another chair. So thank you, and welcome to our panel. We are going to talk today here in this panel about the how. So we've talked about what needs to happen. Sean started us off on why it needs to happen quickly. And I think today we have a fantastic group of panelists. I'll let you read their bios in the app or online, but really get into how projects are being delivered around the world and understand the risk in emerging markets, understand what's happening now in emerging markets, talk about what's working well, and how we build that market out. And then at the end, kind of some of the more positive movements that we're seeing that will enable more money and more capital to move faster into the areas that it's needed. So I'm going to jump right in. And in fact, we're going to jump in with Scott down the end. Scott, you run the ASEAN Green Catalytic Green Fund, which I love the title of, at ADB. Maybe a little overview of kind of what that fund is trying to do. I love hopefully in line with the title, and some examples of what it's been able to do so far, where you're looking and where you're seeing success.
Thank you, and thank you for the opportunity to be here. Just by way of context, our relationship, ADB and the Climate Bond Initiative, goes back to about 2015, when we first engaged CBI to certify the first climate bond in Asia Pacific, first green bond in the Philippines, as it turns out. I was very privileged to be part of that transaction. And it's a world of difference today. Coming to this conference now, back then it was in Guildhall. Here today, to see the state of the conversation very much mirrors, in many concrete ways, and a couple differences I'll talk about, the state of the conversation on climate finance and transition in Southeast Asia. So as you mentioned, I manage something called the ASEAN Catalytic Green Finance Facility. It's a mouthful. What it is it's a financing and knowledge capacity building platform with partners focused on Southeast Asia to drive climate transitions and in particular infrastructure. What that means concretely is that we work with financing partners, primarily governments, bilateral funding organizations, EU, EIB, and the like, roughly 1.9 billion of pledged co-financing, largely on concessional terms, and we put that to work for projects that can really move the needle, landmark infrastructure projects in Southeast Asia in the public sector. Now, why in the public sector? One of the things that we've noticed in Southeast Asia is that the infrastructure needs are absolutely acute, but the private sector is still largely following. That's a theme that's resonated today, but that's especially true in our region. And one of the ways that we're trying to change that is embedding in public sector projects the opportunity for private sector engagement. So an example of that is the technical assistance that we're doing in the bond market. I happen to be here this week with a group of officials from Southeast Asian countries, 5 countries, really to work with CBI on training in the bond market and so forth. This is part of advisory work that we do with public sector issuers so that they can take landmark issues through the system and build credibility, certainty, and sort of a market acceptance for green, social, sustainable, and other thematic bonds. We've done about 6 of them so far in the last year or so. You'll see some of the people from our group here today. Really, I think it's emblematic of the shift towards a climate orientation in the public policy. Happy to talk more about that. Planning around that, and then landmark infrastructure investments that can really catalyze the market. So that in a nutshell is what we're doing. Maybe I'll just give a plug for the UK government, who happen to be financing, supporting this particular tour, and the engagement with all of you and the City of London expertise has been very important.
Great. So 2 billion, not a small number. I'd retire on that. Going into green finance in the region, but it's not just about bonds and loans. And maybe Farnam, I can bring you in here as global head of ESG solutions to talk about that kind of wider system. So we all know about bonds, we all know about loans. Can you give us kind of an overview of what else is there to make a fully functioning market in this space?
Yeah, and without sort of preempting Hamid's perspective, I think it's helpful to maybe take a step back and think about, when we talk about emerging market finance generally, we're talking about a very small pool of capital that is out there, right? And often it's actually not uncommon at all that a project comes across my desk, and I cover ESG across debt, equity, and M&A at HSBC, where the climate credentials are impeccable, and effectively we are solving for all the other risk around the project. So here we're talking about the political risks that might be associated with the project, the currency risk, the credit risk, the other environmental and social and governance risks that investors may see. And I think one of the challenges that we have is, unlike the climate bonds initiative, which has given us that kind of programmatic stamp around thinking about the climate credentials of a given project, across all those other risks that I mentioned, we are still working in a very ad hoc way, where we're developing sort of custom solutions to address all those risks that we're trying to get investors comfortable with in order to bring a project to fruition. And so that's a lot where my group spends a lot of its time, is trying to think through some of those solutions and how we can build those out in a more systemic way rather than just that ad hoc building.
Yeah. And I think maybe we'll come to you, Adebayo, first next to talk about that, what does that look like at a country level? I mean, we've talked about these countries as if they're, ASEAN and Africa. We always talk about them together. They're very complex, very different countries, and there are lots of them. So as an investor, I mean, we'll get to you in a minute. As an investor looking at these regions, it's not an investment in ASEAN. It's not an investment in Africa. It's an investment in a certain country, in a certain place with a certain structure and a certain framework. And also generally in USD, but maybe if you could give us kind of a visual from where you are about what does that look like to invest, where you're investing across Africa, what are those challenges, but how do you overcome them? And maybe a little bit about whether or not you're seeing any appetite for domestic currency investment, because obviously that's a huge risk for a lot of emerging markets.
Yeah, thank you very much. And indeed, Africa is a very diverse continent with very unique country issues. But what we've seen is most of these issues can be the same if you look at them holistically, right? There is the issue of debt vulnerabilities by the public sector. The FX risk seems to be the top burner now across countries, and the last speaker mentioned, the focus is to see how to create bespoke solutions in the country context, right? But for us, our focus has also been to see how we can bring in the domestic institutional investor base into the financial ecosystem. Indeed, in Africa, most of the largest institutional investors, which are pension funds, are currently focused on investing in sovereigns, which goes into financing budget deficits. We think those large pool of funds can be better utilized in the real sector, right? And what we've tried to do is to promote sustainability bonds in the region, which seems to fit into the appetites of investors in the continent, right? And in terms of addressing climate issues, another thing we notice is it's difficult to separate the social issues from climate issues in Africa, right? I was speaking to someone, I said, look, if you approach someone in Africa that wants to cook with firewood and starts telling them stories around how that will impact the environment, I mean, the person will simply tell you, I just want to eat and I want to feed my children, right? So the social aspects, the way we narrate the story really matters in Africa, right? And what you're seeing is addressing this environmental issue from a social perspective has really helped. Is actually more cost efficient to the community, and the narrative around that is what is really selling. For instance, we supported an issuer that manufactures clean cooking stove, right? And the narrative has been, look, it's even more expensive to go buy firewood to cook, right? It's dangerous to your health. It empowers women, right? So there's a gender lens to this thing. So that's is always very appealing to them, understanding the environmental impacts, and also as a way of galvanizing the domestic investor base and raising this fund. I mean, bond manufacturing was able to raise $10 million from the Kenyan markets, and they're trying to replicate that in Nigeria as they move into that market, right? So the social aspects, and which Katie spoke about at her opening speech, is really a key factor in Africa. And I think the narrative is kind of different from what we see in the global world. So it's trying to contextualize the problem across Africa and trying to find a solution to these issues.
Yeah, interesting. So bespoke solutions, but that are scalable and apply across different places. I think, some of the themes that we're hearing. As an investor, Hamid, when you're coming in and you're looking, what are you looking for? Obviously, as you're looking in different places for different things, but maybe can you walk through how you think about this risk, how you look at the emerging markets and where you find value?
Look, at Invesco, we've been exploring opportunities across, different sectors: climate mitigation, adaptation, and also transition. And we've been exploring opportunities in emerging markets. The challenge is big. Emerging markets and developing economies require around like 340 billion per annum by 2030 to adapt their agriculture, infrastructure, water supply and management, and other parts of their economies, right? To build resilient countries and sound businesses, right? And if you think about the asset management community, right, and fund community, we are mainly benchmarked, right? So we follow traditional benchmarks like the likes of JP Morgan or Bloomberg Barclays, etc. And I think this might sound like a little bit shocking, but if you look at those benchmarks, 50 to 60% of the allocation goes to 12 countries approximately, right? The most developed in their kind of capital markets, etc. So for us to go and adventure into like countries, least developed countries, small islands, Africa, you need fund structures and mechanisms that will allow you to increase that risk budget, right? And tackle those issues, but also tap into those opportunities, because we see adaptation as an investable opportunity. We, as the last panel discussion has mentioned, we see that if we don't act today, for example, in adaptation and resilience, right, there would be more costs in the future. So, but there are opportunities today that we need to tap into as an asset manager. But then we need to, as my colleague has mentioned, we need to leverage mechanism and out there, right, like de-risking mechanism mainly, guarantees, first loss, to make sure that we meet the requirements, either the impact requirements, but also the risk and credit requirements for the institutional capital, pension funds and insurance companies, right? So blended finance is a way, I would say, to adventure into those least developed countries and try and increase the risk budget and tap into those opportunities. But it comes with a collaboration, right? You need to understand the whole ecosystem. You need to work with the right partners on the ground. You need also to understand the market. I think Africa is like 54 countries, but each country has very specific requirements and very specific policies. Sometimes they privilege local private sector versus like external investors. So you need to be flexible, I would say, to tap into those opportunities.
Yeah, no, definitely. And so, a lot of different things. I think one of the speakers in the earlier in the conference was also referring to the fact that, to go into the areas where they would have the most impact, they actually will risk, not in the financial risk sense, but in the reputational risk sense of being invested in companies that people will say, well, why are you invested in that? But to the point that CEI makes a lot, is, it is those transitional places where the impact is the best, actually. Just opening it up to all of you, what are you seeing work well? Like, what are you seeing get people moving towards risk, or moving towards having a constructive conversation about risk mitigation in places like in the emerging markets?
Maybe one thing I might mention is that there's been a lot of talk today about narrative. And certainly we're tuned to that as a public institution located in Southeast Asia, but really connected to the global conversation. One of the most important things that we've seen in the narrative, which really underpins the certainty and the credibility of transition finance and transition planning, is the idea that governments can seize their own destiny. Southeast Asia is a very diverse place. You alluded to that generally, but that's certainly true in the region that we're talking about here with Southeast Asia. 100 million people, very large spread of income levels from Singapore down to Laos or East Timor. You have financial systems that are different states of development, capital markets, which are very different states of development. And yet, I think one of the common things that we're noticing is this idea that really it's moving from a vulnerability story for many officials to say, how can we take an NDC commitment and turn it into an economic transformation opportunity? And that transformation opportunity is partly about mitigating risk. Obviously, there's important adaptation risks in that region. It's uniquely vulnerable, long coastlines, a lot of low-income communities, agricultural base, so they're very, very susceptible to changes in productivity and price shocks and the like. And at the same time, a very young labor force, the opportunity to perhaps leapfrog and decarbonize at scale, because business as usual would require them to add an awful lot of capacity to their energy systems, to their transportation systems, roughly 50% between now and 2030. So you have this opportunity to look at that and say, we can actually change our manufacturing base to be lower carbon. And we can do that in a way that plays into global trends and accesses global money, particularly concessional finance, global support, and the like, to actually have a different economy than we would otherwise without climate change even. And that is a very, very important, I think, change in the weather that we notice as a bank, working with institutions on their planning programs.
Yeah.
I think one of the things that we've seen over the course of the past few years has been this building out of kind of platforms is the most impactful. So the one that comes to mind first for me is the IFC Amundi One Planet Fund, which was launched a few years ago, which for those of you who don't know it, it's dedicated towards investing in green bonds issued by emerging market banks. The IFC also invested very heavily in technical assistance to back that fund so that emerging market banks that wanted to access that finance would have support from the IFC in order to build out internally green taxonomies, the tracking and monitoring systems to report on green bonds. So it was an enormous amount of technical assistance from the IFC, as well as giving that carrot of, here's an anchor investor that you can count on if you issue a green bond to finance green projects within the country. And it's had a huge impact, I think. I think beyond just, the $1.5 billion or so of capital allocated by the IFC, they crowded in a lot of private capital as well through the issuance of those green bonds. And more importantly, they built within those banks the foundation for what is now, for most of the banks that I've worked with. So we work with banks across Turkey and Southeast Asia quite closely that benefited from those projects. And they now have much more advanced climate commitments. A lot of them have become signatories to the Net Zero Banking Alliance. And that really, the genesis of that did very much start with the One Planet Fund. And so that platform, I think, was really, really powerful. And so, as I mentioned, our focus at HSBC is thinking through, okay, what are the other platforms that we can build? One that we launched 2 years ago at COP28, we've just announced our first deal, is a Pentagreen Capital, which ADB has been a supporter of as well, a strategic partner. So this is a partnership between HSBC and Temasek in Southeast Asia that's dedicated towards what we call marginally bankable green projects. So addressing some of those challenges around, projects that have great climate credentials. The first project that we're financing is actually solar in the Philippines, but suffer from the challenges around kind of credit risk, currency risk, and political risk that I mentioned earlier. And so coming in again as an anchor investor and then trying to crowd in additional private capital by providing that sort of first loss guarantee for the project itself. So I think it's working towards these platforms rather than, you know, tailored solutions for every challenge that we have, I think has been what's worked really well.
Yeah. And I think also those platforms provide kind of a safety blanket. The markets love to invest in something that's been done before, so that because that's that kind of like, oh, somebody else already invested in that. That's okay. You know, IFC is in there. IFC's done a lot of due diligence. We know what they do. We know how hard they work on deals, right? And so I think when you can create those platforms for people to see, you take away some of the inherent risk of people who aren't based in the regions might have looking at the region. I mean, you know, I was based in Asia for 10 years. A lot of those investments are a lot safer than things I would have touched in other places, right? But it's only when you're on the ground there that you have enough know-how to do that. So the platform is a great way to give that security blanket to other, not security blanket per se. That's a bad term for a lawyer. But, you know, a platform for someone to access to get in. As an investor, do you see those platforms as useful? Are you participating in some, or, you know, how are you seeing those work?
Look, institutional investors, when we speak to them, they need a track record, right? They need to see what are the levels of risks in certain countries. Is this solution bankable? Is this bond scalable as well across region? Has it been successful? Did the company or like the financial institution report back on impact metrics? So all the TA, technical assistance work that has been done by IFC proves that technical assistance is working, right? And it's really important to scale up the green bond, sustainable bond, and social bond universe, right? And also it gives comfort to other issuers across region to come up with similar type of solutions. I think flexibility and collaboration between fund buyers on one hand and technical assistance providers on the other hand is key to make it work, because technical assistance without a fund, like realizing what the work across the value chain is kind of useless, right? So you need to, at the end of the day, to show the kind of like private capital mobilization ratio, like the impact that has been achieved, and also work on how do you scale that example that has worked really well across region to scale up the whole universe, right? And CBI is doing a fantastic work already with that regard. I think for us, like if we want, as I said before, if we would like to go and adventure into those least developed countries, technical assistance will be key, right? We need to work with local actors, with government, with like financial institutions, SMEs, and see what we can do as financial engineers to structure bonds that can then be institutional grade and could be selected by our funds, right?
And work within the parameters. I mean, you mentioned the parameters. I think people don't really think about the fact that investors are actually kind of, you know, they're fenced in to what they can do in some ways because of all of the commitments that are made at the fund level, right? In terms of investment. I think, you know, you made a great example with the cook stoves, and tying back to one of the earlier comments about leapfrogging the systems that didn't work. It makes me think immediately always of telecoms in Africa, where, you know, just straight over the fixed line right into mobile. So I think, are you seeing examples where people are taking a success like the cook stove initiative, and then you said, okay, well, so we've done that in Kenya, let's try that in Nigeria, let's move to all of these different countries. Are you seeing that kind of cross-pollination of ideas?
Yes, definitely we are. And a good example is a credit guarantee agency that was set up in Nigeria, InfraCredits, that provides local guarantees for entities that would otherwise would not be able to access funding from the capital markets due to either a low investment grade, right? That has successfully mobilized domestic investors into this fold. And we saw that as a success in Nigeria, And currently we are supporting the same initiative in Kenya, right, to develop a local credit guarantee. Kenya still has a very low debt market, and this is chiefly because there is no such facility as a local credit guarantee. So those are some of the facilities we are replicating in Kenya, and we hope we can support stakeholders in other countries to have such model to mobilize more domestic capital into this fold. In terms of collaboration, another thing we see in Africa is, Africa is predominantly driven by SMEs, right? So you may not see those large scale projects that you're looking for, you'll see elsewhere. And that brings, the importance of collaboration, right? Both from a regulatory perspective, so that when investors are looking at Africa, they can see some sense of similarities. If you want to deploy capital to Nigeria, Ghana, Kenya, if you have some level of regulatory collaboration and similarity, that would make it more easier to have a Pan-African view, right? So we're supporting collaboration from a regulatory perspective. We have the Africa Pension Supervisors Network that seems to come together to see how they can closely interlink the regulation in a way that would make investors collaborate with domestic investors in terms of either creating a structure that can be deployed across the continent. We are also working with the Pan-African Fund Managers Association. This is an association of 15 member countries of fund managers coming together to see how they can jointly advance the net zero costs, right? And collaborate more with their global peers in terms of working together on projects, on investments, and fund structures, of course, with the rights and adequate de-risking mechanisms that the DFIs can provide. Another thing we see is a mechanism that can make the DFI funding more developmental driven, right? In the areas of portfolio risk transfer. We understand that the development fund is very important in the construction phases of projects. But to make it more work, we have the strong view that once the projects have been de-risked, that capital can be recycled into other projects, which provide bankable projects at scale. So we got selected for the MDB Challenge Fund to develop a structure that can enable this portfolio risk transfer, working with local institutional investors that can offtake some of these assets from DFIs and enable them to deploy such capital into other projects that can be de-risked.
Oh, excellent. And I guess, so those are a lot of really great opportunities coming out of the transition and being supported by policy and by these structures. I guess in the Asian region, are you seeing opportunities coming out of policy, or how is policy intersecting with transition?
So I've given a rather optimistic kind of view of things. There is a pessimistic case, right? So 9 out of 10 ASEAN countries have a net zero commitment, but only about half of them actually have, let's say, sector roadmaps and plans to achieve those. You have 75% fossil fuel share of primary energy. You have pretty carbon intensive industries that are embedded in the politics and embedded in society. 250,000 people in Indonesia would be affected by transition out of coal, for example, because their livelihoods depend on it. So where we're finding the sort of levers are in coordinated cross-sectoral policy actions at scale. And that's the tectonic plate movements that are a little bit hard to see in the markets because they're just now coming through. So I'll give you 2 examples. One is Philippines 2 years ago committed at COP a 75% reduction in greenhouse gas emissions by 2030 versus business as usual, 75%. Very, very aggressive. There are other countries in the region that also have aggressive NDCs, Cambodia 45% and the like, but there is no implementation plan behind that NDC. So if you're an investor not just an institutional investor, but if you're a private sponsor of a company or a bank, what certainty do you have that that's actually a plan that is going to have any economic resonance at all? This is the real economy. And yet the work is underway. It's very difficult in countries where the public sector capacity is weak. And it's very difficult when climate change as a cross-cutting issue has only been institutionalized and capacitated very recently. There is no tradition of this, this sort of approach in the policy sphere, but it is happening, and we're seeing it in every market where we're privileged to play a role as a policy advisor or to bring, let's say, a best practice and technical assistance and the like. So that's one example of that is that, and you see that through the financial system. You see that in the taxonomies that are being applied and rolled out in the bond market. All of this is pointing in a direction which is about aligned and very clear, credible plans. I think we're about a year or two away before we are going to look at this holistically and say, okay, the pieces are in place, but the work is underway. The second is, and you mentioned platforms, country-driven financing, planning, and policy platforms that are holistically around energy transition. And there's some really important cases. The South African model for JET-P has now been taken on with gusto by the Indonesian government. That's a $100 billion plan between now and 2030, 5 times that to 2050, if I remember right. Trying to get to something like 44% renewable energy on the grid by 2030. It's a huge shift and requires grid build out. It requires policies around pricing, introduction of carbon markets, value chains for renewable energy, manufacturing, but in a coordinated package with global support, technical support, and financial support. This is a game changer for Indonesia. Vietnam is taking it on, and there's small versions of that which are being implemented in different markets in Southeast Asia. So that kind of platform, multi-sectoral finance plus policy plus technical work, we're finding is actually having quite a lot of potential.
Yeah. I want to touch on the first point that Scott made, because I think one of the places in which I see this on a day-to-day basis is on a micro scale, this dissonance between the 2030 target or the 2050 target and what is coming to market today is it's very difficult for investors to wrap their heads around the nuances of transition in Indonesia versus Vietnam. And what's happening, I think, in the absence of that is that we're often seeing them apply, frankly, European standards to what should and shouldn't be considered transition financing in emerging markets. And that's something that is really difficult, right? Because effectively, if we start to apply the European taxonomy to projects that are coming out in Indonesia and Philippines, it's never going to pass muster by investors. At the same time, I'm sympathetic to the fact that for an investor to get their head around what Indonesia's pathway looks like requires Indonesia to provide a lot more disclosure and transparency as to what that sectoral piece is. So I think it's going to be a game changer when that information comes out, so that investors can make more rounded and nuanced decisions, so that when we bring, for instance, an Indonesian corporate who is making efficiency investments in cement, that it's clear to them that that's an impactful climate transition, even if it's not comparable to, what Holcim or Cemex are doing in their respective markets.
No, and I think that's critical. And I mean, places like Indonesia where, they're relocating their capital because of the effects of climate change, right? Jakarta is going to essentially be underwater. It's a real thing. And I think that enables the emerging markets maybe in a way that the developed markets don't have that at their doorstep to think about the system solution, as opposed to, I'm going to, incentivize energy transition, or I'm going to talk about reporting, or I'm going to talk about some, specific bits. Whereas in the emerging world, it's sitting right here at your doorstep now, in terms of trying to come up with policy solutions. Yeah.
I think we can, countries need to work towards establishing more like project preparation facilities, right? To help the private sector understand their plans and their commitments, in practical ways. And then they also need to loop in international investors and explain to the local actors, financial institutions or corporations, SMEs in Africa, for example, what are the requirements, right? What work should they do between now and 1 year time, so I can mobilize some assets in such fund, right? And if we see more project preparation facilities on the ground, more stimulation of those bonds, I think we will see a lot of like change, I would say, in this world. Yeah.
Yeah. I mean, because believe it or not, investors are like other people. They're busy, right? They have jobs. They want to go home and, you know, figure out how the new dog is doing and whether or not he's done damage in the house. And so, you know, you have to make it easy and accessible for people to do something that's not BAU, right? And moving into an emerging market for someone who's not familiar with it is definitely a difficult risk perspective, you know, in a fixed income, definitely environment. We have some time for questions, so I'm going to open it up. I think look, I got like 4 here already. And I'm just going to go arbitrarily based on the first one I saw. So can we get a mic down here in front? And then I see 1 in the back and 2 over here.
Hi, this is Sachin Shende, Pharmaceutical Technologies. So we are a B2B enterprise software as a service technology platform for agri-food businesses in India. And through that, we connected we are on course to connect 20,000 farmers through these agri-businesses. And by end of H1 next year, it will be 50,000. So this is a question for Farnam, Hamid, and Scott. There are 2 parts to this question. So the first one really is in agri-food supply chain, especially we are seeing a lot of short-term view in the supply chain, where farmers, including and the agribusinesses or aggregators, they extract value of the supply chain, right? But effectively, there's no long-term view to invest back in the supply chain, right? Whereas, you know, we have these existential challenges like soil, water, and whether we will be able to grow the crop or not in next 5 years, 10 years, we don't know, right? So as a financial institution, how are you forcing this change in the mindset? As look, you know, existing commercial model might be broken, but we are willing to sit with you and really kind of take a long-term view. So that's the first part of the question. And the second is, given the size and scale of your institution of banks or asset manager, my understanding is you work with certain size and scale on the other side of the companies. So what are you doing or what are you working on at the moment to work with smaller companies like us, where actually through our tech platform, we can give a lot more visibility to deploy the capital and bring in some impact and change on the ground? Thank you.
So I think one of the phenomena that I think is going to play itself out over the course of the next few years that is going to really impact the agricultural supply chains is the commitments that are being made today by the large corporates to decarbonize and apply stronger sustainability standards across their value chains, which effectively will trickle down into SMEs and smaller businesses. And one place from an HSBC perspective where we're starting to see this really play itself out is through our supply chain financing platform, where we're seeing more and more corporates start to avail themselves of sort of sustainable supply chain products, whereby we can, as HSBC, offer either better terms or more flexible terms to suppliers that meet certain sustainability standards. And we're really aided here by the fact that we have much better transparency and visibility on those standards across supply chains because of technological solutions like the ones that you're describing. But it's still very complex, right? Because you're talking about a supply chain that has become so disintermediated over the course of the past couple of decades. So, you know, when a large corporate starts by thinking about their first and second tier suppliers, we're still about 8 chains away from the farmer that you're talking about. And so again, here we're trying to think about, is it the IFC? Is it, you know, the ADB? Is it another multilateral development bank that can then play a role to support the farmers on the ground? Because it's so disintermediated that, you know, our reach doesn't quite get there. But I do think that the corporates have made commitments that basically require them to start thinking about that. And we're starting to see that through our supply chain financing platform.
And I would add to that, even if your corporate hasn't, the EU is moving with or
Right.
without you. And so there is legislation coming in that will require EU companies of a certain size and turnover to diligence their entire supply chain for environment and social issues. And there's already in Germany a supply chain act which does this. So you get the law even if you don't have people with good intentions. I don't know if anybody else wanted to answer. Otherwise,
Maybe just a quick comment from our perspective. Obviously, we're in a heavily agricultural based region of the world, and we're finding it difficult to have impact in that issue at scale. So private companies, yes, we access them through our direct interventions in the private sector, concessional financing, sometimes blended in, but really it's a drop in the bucket. And so typically what we end up doing is trying to engage in these issues through FIs, where we can provide credit lines with a certain orientation and so forth, either in the private sector or the public sector. And that's been more impactful. And we can see more and more cases around the region where we're able to operate at scale with an intermediary. The challenge that we're finding is in the financial sector, there isn't yet an orientation towards climate risk or climate opportunities. But again, all the work that's being done by Southeast Asian countries to embed green policies and principles and requirements, the central banks, the ministries of finance, the regulators, it's beginning to come in, and we see it in specific areas. And so again, this is kind of moving tectonic plates. Quite humbly, we're a small player in a very large market, but being able to leverage the policy apparatus to bring those ideas in is where we think the solutions are going to be more sustainable.
Great. In the back, there's in the orange jacket. Can we?
Thank you to the panelists for the interesting discussions. I'm Honorata. I work for IFC. For a sister fund of the one you mentioned, we work with HSBC on the Regio Fund. Our role is to develop green bonds in the real sector, and it's a super important subject for transition and also for the steel industry, cement industry. And what we see in everyday work, that we develop bonds with higher standards. We use the sector criteria of CBI. We use the EU taxonomy. And the problem we have across our program is the ticket size. So I in fact repeat the question in a different way. What are the incentives for the bankers? As you, Anne-Marie, said, bankers are people who are very busy. What are the incentives for bankers to work with smaller ticket sizes?
Anyone?
I can take that question. Actually, I wanted to comment on your question as well, the second part of your question. So this is how the investment industry works. You have different funds, different criteria. Some SMEs, they are perceived to be risky, right? So to be qualified for funding from, let's say, an IG credit rated type of bonds, it's very impossible, right? So that's why I was talking about blended finance, right? Because then you can add that kind of layer of flexibility, go to lower ticket sizes, try and work with the SME on how do you enhance the credit rating, how do you report back on certain impact and KPIs, because at the end of the day, we need to understand your business. We need to see what's the impact that you are trying to achieve, and if that impact actually is aligned with the policy of the fund itself, right? So it depends on, there is no like a kind of, the private sector is not one pool of assets that has similar criteria. It's many thousands or probably millions of funds, right, with different like funding like routes and criteria as well. In terms of the standards and IFC standards, etc., I think the industry is trying to like follow the best market standards, right? What we found difficult is there is no like harmonization across all kind of like taxonomies or the criteria that are being set up by certain different groups, right? And we've seen that in particular in adaptation. In adaptation, it's very tricky like to find a common like information disclosure which is kind of standardized across issuers. But the CBI and other EMEA and other organizations are trying to do their work to help with that.
All right, so a call for adaptation EBITDA, I think is what. There were two hands here.
Hi, very interesting discussion. I'm Elena with Mitsuho, currently focusing on project finance. I was actually previously at the IFC. So my question is, with regards to Hamid's point on project preparation. So in a lot of developing countries, emerging markets, project preparation, I completely agree, is extremely critical. But we have already a lot of project preparation facilities out there. GIF, IFC's upstream, ADB has their own Program for Asia, AFDB, Africa 50. They're all doing early stage project development, project preparation. Now, the issue is in a lot of these countries, project preparation comes in with a lot of risk that a project may not convert into something bankable. So in your view, what do you think can these organizations do to make things better? Thanks.
Collaboration. They need to speak to the private sector. We need to explain how do we operate, right? And the way the criteria of our funds are working. And I think for us, like we have different, I'm talking about the industry in general. There are different like investment strategies. I talk about sustainable food, for example, and agriculture. You have like climate adaptation or climate mitigation. Each portfolio manager would have certain kind of like investment criteria and would want to tap into certain like opportunities. The other thing that you need to bear in mind is those funds have like a certain geographical universe, right? When we talk about least developed countries or small islands where the majority of these multilateral development banks are operating within, you need to tap into those like blended finance structures, right? That have some leeway, some risk budget to go and explore opportunities in those countries. So there is like country criteria, then there is like thematic or like subsector type of criteria. And we need to have a discussion with MDBs, which we are doing, right? There are a lot of like private mobilization teams across like MDBs, and they have a lot of like structures, IB loans, etc. And we speak to them. We just need to find the right balance to consider those opportunities.
Yeah, if I may just.
Sure.
Yeah, I mean, I'm drawing from what he said. I think the structure of those project preparation facilities also matters, right? What you've seen in Africa is the project preparation facilities are always detached from the actual investors, right? So they are always output-led, right? So you gather some beautiful portfolio companies, you run them through governance training, you develop models for them, and that is the outputs, right? And you leave those portfolio companies trying to scamper for investors. And they meet the investors bring different criteria and say, oh, sorry, this is not what I'm looking for. So what we've seen work is to actually attach this project preparation facilities very close to the financial close, right? That is the actual investor that would or that has interest in investing. Then he can look at the project at a very early stage and say, look, these are the 1, 2, 3 things I needed to fix. Then I'll be able to deploy my capital. And we've tested that model with the infra credits in Nigeria. We have a construction finance facility with infra credits in Nigeria. And the condition is your project needs to have gone through the credit approval phase. That means they have a credit approval already, but there are conditions precedent to investing. So they deploy this facility to address those things to unlock their capital. I think that is what we've seen work, and we're trying to see how we can scale that on a regional basis.
Excellent solution. Just in front there.
Hi, my name is Pranjal from KPMG. Thank you for this discussion. I had a question around a theme that you guys covered towards the end, maybe around regulatory differences that exist in emerging markets and in developed countries. And one that comes to mind is the CBAM, which is obviously to stop carbon leakage from the EU. To what extent do you guys feel that in investor circles, this is actually promoting capital to emerging markets? Because in my mind, it almost act as an impediment in some ways, because the carbon price differential might be too significant a risk to deploy capital, and firms might be trying to reduce their supply chain resilience on countries that don't meet that requirement. So is this something that has come up, or is there some kind of different opinion you guys might have on this? Thank you.
Anybody want to touch CBAM?
That's a lawyer's question.
All the hard ones end up at the lawyers. Well, it's a really interesting question, actually, and a very live question. And you know, this is the beginning of CBAM. Everybody's starting to monitor now with kind of a phased in approach, where it will get to a place where you will have to pay if your carbon is more than the EU. And it very distinctly a desire on the EU's part to create a level playing field for their own companies who are trying to do the right thing. I think it's going to be an interesting question because it's kind of wrapped up in the EU legislation, with also a lot of incentives to try to bring manufacturing into the EU, back into the EU, because it hasn't been there for a really long time. And so this is kind of this deglobalization theme that you're also seeing happen in the US and in various other parts of the world. So I think watch that space. I think carbon pricing is going to come on faster than you thought before, now that you have it embedded in at least one legislative act. Question over here.
Hi there, my name is Michael. I run a technical assistance facility called Nature for Water. We develop water funds. We have over 30 in development at present globally. And I'm really enjoying some of the questions around project preparation. I just thought to paint a bit of a picture quickly around the challenges we experience, particularly trying to get private money into some of the projects we develop. So we're working at a catchment scale, very, very large, 3,000 square kilometers at least, trying to clean up catchments to improve water security, dealing with a lot of natural capital, etc. We have to be very creative with the solutions we develop. We have to think out the box. There's not a single instrument or mechanism that we develop that's conventional. Okay, so we have a very high willingness for creativity. However, when we go to the private sector, private allocators, private equity houses, and maybe even institutional investors who are maybe 5 or 6 or 7 arms lengths removed from the underlying, we actually do not find the same kind of willingness to be creative and to sit with us at the table and help us with the design to actually get it to that point that we were speaking about, to reach financial close. So I think my question is, do you find that there is an appreciation that private capital allocators need to have a hand in design, and they can't simply stand back and say, we're waiting for something that fits the bill for us, that's bankable, that we can actually invest in?
That's totally a banker question, sorry.
I mean, I agree. We've talked a lot about parameters, and I think that is basically a consequence of the parameters that we've been discussing, right? Is the fact that when people look to allocate capital, they're doing that based on the parameters that they've put into place, and that's why you end up with smaller and smaller pools that can look at any particular instrument. I don't think there's like a lack of willingness on the part of bankers or others to get creative and look at solutions. I just think, if you look, for instance, at, the debt for nature transactions that have happened over the course of the past few years, each one of those has been sort of 2-3 years in the works before it's come to market. And the relative impact of the transaction has been that the next one has to start from scratch all over again. And so, I understand your frustration, but I also think, in a way, this is why working within the parameters that are out there and thinking about, okay, is it an MDB that comes into play here that looks for that creative solution, and then the MDB can use its balance sheet, its credit rating, its relative sort of liquidity in markets to be able to channel in the finance to get to your projects? Or, is it a government sponsor that can do the same thing? I think that's the way in which you get large scale into the projects that you're talking about, because I think the challenge with asking people to be creative is that you end up with projects that are extremely resource intensive, time intensive, and effectively don't get us to the scale that we need.
I think it goes also back to what we've discussed earlier, right? Like, do you have a TA that's benefiting a fund or no? Because if you have that, the fund will explain to you very well what's needed. You won't have that issue once you've developed your instrument that I'm intrigued to hear about, to see like what are the criteria, right? How can this instrument that I'm building in the water sector can fit into the mandate of this asset manager, right? So if you have a kind of collaboration between the TA and the fund, I think you can probably achieve more. And I can tell you that the private sector listens to all sorts of ideas, right? So, and we are looking to engage.
I do have one other point that I just wanted to make on this. So one of the other projects that HSBC, IFC, and a number of other players, including this climate policy initiative, have been a part of over the course of the past few years, is called Fast Infra. I'm not sure if it's something you've come across before, but effectively it is a sustainable infrastructure label. The project, the sort of subcategories that they've started with have been around renewable energy. At COP, they're going to announce the first 10 projects that have gotten the label, but the intention has always been to expand it across infrastructure, including water. And so that's another way in which you could potentially look to get the scale behind the projects that you're looking at.
Maybe I could just make one quick plug for MDBs. I think creative solutions, I think, are needed by everyone. The climate crisis is stretching all of us, right? To think multidimensionally, with different time scales, and to be much more creative and risk-taking. That's certainly true for the MDBs. And I think if I don't want to represent all MDBs, but as far as the ADB goes, we're really taking on this mandate, I think, with intention and ambition. We've pivoted to become a climate bank. We want to be at 75% climate finance by 2030. And a lot of that comes in looking at ways that we can unlock private sector investment. That being said, our clients are owners, or owned by 68 members, are really pushing us to do more. And one of the areas in which we really need to do more, I think, and it's a personal statement, is on nature-based solutions and natural resource biodiversity conservation as an investable opportunity. That isn't to say there isn't a sense that how to do it. It's just really about kind of the scale intention here. So if anything, I think this is kind of an area where we need to do more. One bright spot that I see today is that philanthropic capital is starting to come in some cases to augment what we're doing, complement what we're doing, in some cases to nudge what we're doing. And being able to layer in different types of capital with a different amount of risk appetite, sort of securitization approach to private sector project preparation is, I think, the next frontier of blended finance. You mentioned Pentagreen. That's an example where we're doing that with you, HSBC, different layers of risk, apportioned to different slices of the capital stack. So I think this is an area where we have to do a lot more.
All right, that's 14. Can you get it in 14 seconds? All right, quick, talk fast.
Thank you. Very quick question. We work a lot with domestic financial institutions, commercial in nature. And one of the issues that often happens is the large domestic institutions with whom the ADBs, IFCs of the world normally transact with are not the ones who are most agile on sustainability. It's the number 3, 4, 5, or the mid-level who are more agile. Now, in airline industry, you have something called the Star Alliance, where everyone is on the same platform, same criteria. Now, I may sound crazy suggesting this, I don't know your views, but if there was a Star Alliance sort of equivalent consortium banking network led by front-running institutions like, say, HSBC on the commercial side or ADB on the development side, which are working with certain mandated, smart, agile financial institutions in each domestic, market of, let's say, Asia, Africa, South America, so on and so forth. Can that be a way of scaling up the entire conversation? Because at least then you have certain number of FIs in each of these markets who really becomes smart sustainably. Because right now, everyone is trying to do a little bit here and there and not really reaching anywhere. I don't know if I took more than 14 seconds.
More than 14 seconds. Okay, more than 14 seconds. So yes, no, maybe across the panel.
Yes.
Yes.
Maybe.
Yeah.
Okay. Thank you. Please join me in thanking the panel.